Good morning. We're joining you from the KZN Midlands. I have with me Roy Lamb, manager of our Harvard House property portfolio. And you may have read our special edition of Intuition. And what we thought we'd do is just color that in with some video interviews. So, Roy, thanks for joining us this morning. How are you coping on lockdown?
No, thanks very much, Robin. Trying times, markets, and I think in most individuals as well. So, little bit getting a little bit housebound, needing to get out, but managing to hit the garage with some rollers to relieve some of that stress.
Awesome. So, Roy, we look at the reasons for the property sector being so hammered, and you outlined them quite nicely in the note, the special note, as we did in Intuition last month. But won't you just talk to the conditions, maybe sort of what's happened in the dynamics between retailers and property stocks, and how you're seeing things at the moment?
Sure, Robin. I think there's so many unknowns for not only the retail property sector but also the office side. I think a lot of companies might be realizing that working from home might become a lot more viable when things return to some kind of normality. So that could see a further reduction in space in a sector that's already got excess supply, specifically in Sandton, Rosebank, and pockets of Cape Town and KZN as well. So from the office side, we think there's a good chance of further pressure. From the retail point of view, I think in the article we chat about the rental income under threat for a lot of these companies, a lot of these landlords, and that's predominantly because of lack of turnover, specifically for the so-called non-essential shops, which is, it's hard to believe that you can have a non-essential shop in a mall, because if it was a non-essential, effectively it would be redundant anyway. So it's a very tricky and precarious situation for shop owners and landlords alike. We've seen a number of the big retailers on the clothing side just coming out saying they're not going to be paying rental for the foreseeable future until things settle down, which one wonders how the landlords will be able to cope, because their cost base isn't going to change. They're still going to have electricity rates, taxes, maintenance, upkeep to pay, and yet you're having the likes of Pepco coming out saying they're not going to be paying. I don't know what the contractual obligations are. So that it's a little bit of an unknown. But if the large listed retailers are putting pressure on landlords and they are under stress themselves, it makes you wonder what the smaller mom and pop type stores are going to be feeling, and how they're going to react to the large chain stores not paying rent. I don't think they're going to be inclined to be paying instantaneously, that's for sure. So on the office side, we see pressure. Retail side, a lot of unknowns. On the logistics and warehousing side, that's slightly different. Perhaps we're going to see a more of an online kind of sales base taking up space in a lot of the logistics and warehouse arena. We might see a slightly more aggressive move to online shopping from a lot of individuals, although the South African dynamics are certainly a lot more different to the global developed markets in terms of distribution and that final mile delivery, which is of key importance. So there is still a bit of an unknown in the logistics space as well on how things will pan out after the whole lockdown and the return to normality takes place. So I think the market is concerned for these property companies on the gearing, the loan to value, how they're going to meet their covenants with the banks. The banks obviously are concerned about the rental income, and this gearing moving totally out of sync with their covenants and with what these property companies are capable of withstanding. But I think the property companies, the REIT Association, has been in touch with a number of banks and government to try and relax some of the legislation during this period. So that hopefully will take the pressure off. And I think the focus is going to be on the interest cover ratio, which is probably more important at this stage of the cycle than a pure loan to value, because the actual value part of that LTV equation will also be under stress, just from a pure buyers in the physical market will also suddenly disappear when they see how tough the conditions are. So that the V part of the LTV is a bit of an unknown. Well, it's going to be under huge pressure, I would have thought, with the loan staying constant, the value declining. Those ratios are really going to be tested to the limit. So I think those are the kind of key issues at the moment: rental income, collections for landlords, sales from the retailers, and then the LTVs from the banks, and now the interest cover ratio, which is becoming more of a relevant valuation method.
So, Roy, I mean, we're familiar with the idea that the market always prices its concerns into a share price at any given point. So for property investors, and I know that over the last little while you've been looking to improve the quality. I mean, one of the things that we've done both in your portfolio and in clients' portfolios is look to really be out of the sort of lower quality where we can, try to move to higher quality from a local perspective. And then internationally, we've tried to migrate to the higher yielding, sort of higher returning markets, and they pretty much are in the same space in terms of lockdown. So let's maybe just talk post lockdown. So, because there's no doubt that this will work its way through. We don't know how that's going to be, but as things start to come back, how do you think we can see this property market sort of react in when this starts to settle and we get some clear from the gloom?
Yeah, it's a difficult one, Robin, because really we've seen a number of the locally and European listed property names pause their dividends. Some have cancelled. Some are potentially going to be paying later in the year. The likes, and you could arguably say some of those names were slightly pressurized anyway because of the conditions, so they were of a more highly geared nature than some of the others. Things like SA Corp, Hyprop, Texton, Mass in Eastern Europe, they've all postponed or cancelled dividends to a large extent this year. This half. Potentially going to come back on stream next year. So we have been trying to place portfolios, adjust portfolios with the weaker names to try and improve the quality during this time, while also increasing the yield, because the yield on a lot of these names, assuming that these companies are going to be able to pay, even if it's 20-30% lower than the current yield, they're still going to be very attractive versus cash and bond yields that are offered going forward. So it's always a tough ask on when things are going to return to some type or degree of normality, but one has to assume that the landscape will change, but these companies will adjust accordingly, and the rentals will start coming back to the landlords and eventually be able to be paid out to shareholders. It's just a matter of the time lag. But I think the market is suddenly concerned that, well, these property companies, you bought them for a specific reason of income, and now they're not paying an income. So you've had a weak sector and shareholders that are also concerned about income. Now they're saying, well, let's just sell anyway. It doesn't matter the price. They're not paying income, so let's just get out. So that could also be providing opportunities to buy higher quality names at not, I don't want to say bargain basement prices, because they could easily go lower if the circumstances get worse. But that's our kind of feeling, that we're wanting to adjust portfolios to higher quality, more stable yields, maybe not as high yields as some of the low quality names, but I think the risk reward has to be taken into each portfolio as accounted.
Yeah. So I mean, if we just picture, and I want to pick up on a little point that you said there, looking forward. So if we assume things do normalize, and it will be a different landscape, but fast forward maybe a year or maybe even 6 months, and we have a situation where an investor is sitting and going, well, with cash rates having dropped because of markets, or the central bankers having reduced to try and give some space in the economy. So I know my fixed deposits have maybe sort of moved from 8 down to 7, might move down to 6. The bond market trading at 11 or 12, and even if we see some big cuts in the dividends, it's potential that there'll be quite a premium yield on the property sector at a later point when there's a little bit less mist. Does that sort of suggest that potentially we could see a very strong recovery in share prices, as investors decide that once there's more certainty and there's a higher yield here, there could be some big demand on the quality names?
Yes, I think you're right, Robin. The search for yield is going to come back into focus again with the drop in global interest rates and the release of liquidity into the market. But income is still key, and with rates in the US and Europe being pretty much close to zero, negative rates on the radar once again, yield is going to be very attractive. So that might. I know we've chatted about it before on the SA bond point of view. I'm sure Billy will touch base as well on our thoughts around that. But the SA bond yield will be attractive considering what investors can get offshore, and they'll also price in the relative risk of the government defaulting and the relative risk of ourselves versus other emerging markets. But from a property point of view, even though it's generally a late cycle play, with the way that the actual capital value of these shares has been decimated, any sign of stability, coupled with plenty of liquidity, low interest rates, attractive yields, and if the market does, and if these property companies do adjust to conditions accordingly, there could be a massive scramble for the higher quality names.
Awesome. So as an investor in a property portfolio at the moment, would you be taking the exit, or would you be sitting it out looking for that hunt for yield a little bit later down the line?
No, I don't think I'd be looking to sell out at these levels, because if you've bought in at a much higher price, even if you bought in at yields of 8% versus current yields of north of 12, 13, 14, 15%, if you're selling out now and you're trying to lock in a fixed deposit yield, they're going to be very different to the current yield that you can get at the moment in the property space. Plus, you're never going to be able to recoup the capital balance that you've lost during this downturn. Which, yeah, I just don't. I don't see, unless the specific company has got so many issues that it's potentially going to go bust. I don't think selling it at this point in the cycle is going to help your long-term capital and income growth. That is for sure.
Yeah. Well, Roy, thanks for giving us your time. Let's hope that our lockdown is not extended and we stay with the 21 days and you can get back on the bicycle and work off all those snacks that you're eating in the meantime. Really appreciate your time.
Pleasure, Robin. Thanks very much.